Understanding overcapitalization in corporate finance. Overcapitalization is a critical concept in corporate finance that occurs when the value of a company's capital exceeds the worth of its total assets. In simpler terms, it signifies a situation where a company possesses more debt and equity relative to the value it retains in its assets. When a corporation is overcapitalized, its market value drops below its total capitalized value. This condition can lead to unsustainable obligations regarding interest and dividend payments, stemming from the excess capital. Over time, this scenario can place the company in a precarious financial position, hampering its operational efficiency and long-term growth prospects. Key takeaways. Definition: overcapitalization arises when a company's total debt and equity outweigh the value of its assets. Consequences: companies may face burgeoning interest and dividend payments that can erode profits. Causes: this phenomenon can result from poor management decisions, high startup costs, and market volatility. Mitigation strategies: companies can resolve overcapitalization through debt repayment, restructuring, or, in extreme cases, mergers or acquisitions. Comparison with undercapitalization: the counterpart of overcapitalization is undercapitalization, which refers to insufficient capital to sustain operations. Capitalization explained. Capitalization encompasses the total amount of debt and equity that a company has, effectively defining the financial resources that are invested in the business. This incorporates assets such as stocks, bonds, and retained earnings. A carefully balanced capitalization is essential for a company's financial health. However, overcapitalization indicates an imbalance where the issued capital surpasses operational needs. Companies facing overcapitalization encounter challenges such as profit drain. High interest payments and dividend obligations can significantly reduce the retained earnings available for growth, research and development, and other investments. Market perception: excessive capitalization can negatively impact the company's stock price, making it unattractive to investors. Funding difficulties: an over-leveraged company may struggle to secure additional financing, as lenders and investors may view it as high risk. Causes of overcapitalization. There are several factors that can lead a company into an overcapitalized state. 1. Asset acquisition: purchasing assets that do not integrate well with core operations or acquiring them at inflated prices can lead to overcapitalization. 2. High initial costs: organizations might record substantial startup costs as assets, which subsequently distort the balance sheet. 3. Economic fluctuations: changes in economic conditions or market demand can drive down earnings, exacerbating the issue of overcapitalization. 4. Management missteps: poor strategic decisions and inefficient capital management can also contribute to an overcapitalized situation. Addressing overcapitalization. To correct an overcapitalized situation, companies have several avenues to explore. Debt restructuring: refinancing existing debts can mitigate interest burdens and improve liquidity. Interest payment adjustments: companies can lower interest commitments by opting to pay off long-term debts. Share buybacks: conducting share buybacks may reduce the number of outstanding shares, leading to decreased dividend obligations. In some instances where restructuring proves unviable, mergers or acquisitions may be the best path forward to regain financial stability. Overcapitalization in other sectors. Overcapitalization isn't limited to corporate finance alone, it also appears in industries like insurance. In this context, overcapitalization happens when the number of available policies surpasses consumer demand, leading to a saturated market characterized by falling premiums. This scenario can severely impact an insurance company's profitability. Benefits of overcapitalization. While often viewed negatively, overcapitalization can carry certain advantages, such as liquidity. Excess capital on the balance sheet can enhance liquidity and enable the company to invest in growth opportunities or even capture advantageous market conditions. Acquisition preparedness. companies situated within an overcapitalized condition can potentially realize higher valuations, making them attractive merger or acquisition targets. Overcapitalization versus undercapitalization. It is essential to juxtapose overcapitalization with undercapitalization. Undercapitalized companies struggle to secure adequate cash flow or credit necessary for operations. This situation is predominantly observed in startups with overpowering initial costs, inadequate funds, or excessive debt burdens, and can lead to bankruptcy if not managed effectively. Example scenario. To illustrate overcapitalization, consider a hypothetical construction company, ABC Corp., which earns $200,000 a year and has a required rate of return of 20%. In a healthy scenario, ABC would need $1 million to balance its capital needs, $200,000/20%. However, if ABC opts to use $1,200,000 as its capital instead, its rate of return subsequently drops to 17%, $200,000 divided by $1,200,000 times 100, reflecting the detrimental impact of overcapitalization. Conclusion. Overcapitalization poses significant challenges for companies, primarily characterized by an imbalance of debts and equity against total assets. It can strain earnings, limit growth potential, and cause reputational damage in the eyes of investors. Understanding the underlying causes and potential remedies is essential for any organization striving for financial health and operational efficiency in today's evolving market landscape.